Good day, fellow investors. Charter Telecommunication was a highly requested stock recently, and then I checked it. I see it's down 65%, and some of you also sent me an email and told me that Charter Communication, according to Data Roma, is the most bought stocks by super investors followed there. These are those ones buying. I must say I don't know many of them, but we have Warren Buffett, Berkshire Hathaway, percentage of portfolio. He bought early when the company likely went public, sold a little bit over time, but we are now back to Warren Buffett's buying price. This is from Stock Circle. Now, let's do the standard analysis, what we do here. Check the business, check the financials, competitive advantages or not, risk and reward investing. And if you like that, please smash that like button and consider subscribing. If I look at the business, cable company, connectivity company, broadband connectivity and cable operator serving more than 32 million customers in 41 states through the Spectrum brand. This is what they are, and now we have to see what's going on. Why is the stock down 65% for terrible returns, and see whether it is now a value opportunity or not. If you look at the company, you're looking at the revenue flat, EBITDA flat, then it could be a cash cow at some point in time because of the 3.5 billion of cash flow, now a little bit lower due to higher capex, but if that capex goes down, the cash flow goes up, and then it could be again cheap because 6 billion in cash flow on 40 billion market cap, that's a 15% free cash flow yield, which is something that raises an eyebrow or two. And if we look at what they are doing, they have had a small decline in residential additions. That's negative, but they think that with the investments, with everything now, with the deal with Disney, etc., they will keep on growing. They are expanding on subsidized rural with good returns on investment, attractive greenfield returns, so they hope to do it there and get back to growth. All in all, it looks stable, earnings a little bit down, 10% down, but if I look at the business, they have this huge capex that they are spending for line extension, scalable infrastructure, etc., and they plan to spend even more money on capex going forward. And if that leads to higher cash flows in the future, it looks good. But when you look at finances, cash flow, there is an itsy bitsy little bit of debt there. They did spend huge amounts of money to repurchase 50% of outstanding shares since September 2016, but they did spend a lot of money on repurchases. However, they now have 97 billion in debt. Yes, that is more than some countries have in debt. And here is the debt maturity profile. Huge refinancing in 2027 and then a huge pile of debt. Okay, weighted average life of debt 12 years, fixed rate debt at 86%. But as those maturities mature and they are considered high-risk stock, that is junk debt, they will have to refinance at higher rates, 100 billion at the rate of 8%. It is $8 billion in interest costs. They have now about 5, given the lower average cost of debt. What is that? 5.3. And this then deducts 3 billion from their cash flow. So what they can get maybe from lower capex will be their higher from higher interest cost payments. However, they say prudent leverage. One might disagree with that. Let's see the financials and try to make a valuation if possible. If I look at the financials, okay, revenues have been growing slowly and steadily, have stagnated last year. So that is also something that with these highly leveraged companies, once the stagnation comes in, then everyone is worried, but operating income has been going up in the years, and if they can continue this, great. But operating margins are good, and now competition is already coming in. Net income has been up and down, but okay, stagnating a little bit now. However, there is a lot of goodwill and intangible assets, so that debt is not backed by tangible assets, that debt is backed by goodwill and other intangibles from the past, and that is another huge risk. And then if you look at the cash flow, you see that there are high capex, but they spend a lot of money on repurchasing. 11, 15, 21, 32, 47, 67, 70 billion and more in the last 7 years on repurchases, and they say they bought 50% of the company, but the company value now is 40 billion. And this is exactly how you destroy value with buybacks. But why do you push so much on buybacks? Well, because you have a contract, you want the stock to go higher, and then you make more money as a CEO than a baseball star. The thing is that there is competition now. T-Mobile adds these fixed wireless users and excess capacity approaching now. So that is the competition there. And then you have to see, when you have such piles of debt with the cash flows, the certainty is that you will never repay that debt, which means when the situation gets tricky, you go bust. That's it. Therefore, this is a pure gamble, and that's why Warren Buffett bought in 2016, tested it, sold, took his money out, and left it to see whether something will change. But having so much debt, okay, the management took debt to do repurchases when interest rates were close to zero, free money practically. That was smart, but they also assume that their business is indestructible, that has a huge moat. That's what Warren Buffett looked for. Now cable doesn't have a moat as it might have been a few years ago. So I think it is a bet, because yes, if you look at the cash flows, it looks interesting. Maybe they can push to 5 billion, 12% cash flow yield. Even with higher interest rates, they can, let's say, do something there. But given the competition, I don't know how will this look like 10, 15 years from now. I know that 10, 15 years from now, the debt will still be there, and that will be on the money they spent to do buybacks, mostly here, at crazy high prices. Now they need to refinance their debt. They took it low at higher rates, and that is a huge risk. So yes, if things improve, if they start growing again, the market will like them, and you have a 2x here. But if things don't improve, and there is a financial crisis, this goes bankrupt. So 2x versus ugly versus losing everything. Not a value investment, not a bet I will continue following. Thanks for watching. I hope I'll find something better in some other of your suggestions. I'll see you in the next video.